Short exercise 5-5. We are now going to be doing the same transactions, but this time for the seller. Back to my scratch sheet. I neglected to label this stuff. Always label your scratch paper so you know exactly what is what, otherwise it can get confusing later on. All right, so now we're going to journalize muddyriver.com's transactions. So remember, this is the seller. All right, October 10th, the sale of 2,000 books on account for $19 each. And the cost of these books to the seller was $22,800. Credit terms, 120, net 45. So it says, begin by preparing the entry to journalize the sale portion of the transaction. Do not record the expense related to the sale. We will do that in the following step. So this is the author's way of reminding you that there are two different transactions when we sell merchandise. The first transaction is the price. The price means the price we are charging the customer. So that will be sales revenue. And then the second transaction is our cost, the cost to us. In other words, cost of goods sold and inventory. But whenever we sell merchandise, the first transaction is always the amount that we're going to charge the customer. So how much are we charging the customer? We are charging the customer 2,000 books times $19. So we're going to charge them $38,000. And since we sold them on account, are we going to get cash or are we getting AR? We're getting AR because we sold them on account. That means the customer is going to pay for us later. So this $38,000 also represents revenue, sales revenue. And if you forgot why we are debiting AR, AR is an asset and we have more AR, so it is increasing. So that means it has to be on the debit side. And sales revenue over here, revenue increases on the right side. And we have more revenue once we make a sale. So I should keep track on my scratch paper. I'm going to do a new tab, a new worksheet. I should keep track of AR so you can see how we calculate what's going on. So view, I don't like to see the grid lines. So we're going to create an AR account. Merge and center. We need the left line, left border, and we need to put our pluses and our minus to remind us which side is which. And again, I'm getting the plus and minus from here, our accounting grid cheat sheet. So AR is increasing, so I'm going to post. Why am I putting it here? Because AR is being debited, and this represents our sale. All right. Now let's go down to the second transaction. It says journalize the expense related to the October 10th sale. So what this is saying is we need to lower the cost of inventory, and we need to lower inventory, and we need to increase our cost of goods sold. Let's talk about inventory first. This is easier for most students to understand. When we sell our books, the inventory, which is an asset account, is going down. So that's why I'm crediting inventory. And then cost of goods sold, remember, this is an expense. So we increase the expense. And how do we increase expenses? On the left side, the debit side. So again, this is the cost to the seller, and then we're lowering inventory. So really what we're doing is we're transferring the asset, from the asset, we're lowering the asset, and we're going to be moving it over into expense called cost of goods sold. So that's what's really going on here. Okay, not too bad. So now it says the Salem store returned 100 books that were damaged in shipment. So we need to record the sales return. So here's what's going on. Up here, we made our sale. Both of these transactions represent the sale. And now they're going to return some of it. So when the customer returns it, we're going to reverse all these transactions. But instead of lowering sales revenue directly, we want to keep track of sales revenue. So we want to keep track of sales returns. So sales returns and allowance. So again, what I'm doing is I'm going to offset the sales revenue by using this contra account called sales returns and allowance. And then I need to lower AR because the person doesn't, or the buyer doesn't owe us as much. So again, I am reversing this, but instead of reversing sales revenue, I need to use the contra revenue account called sales returns and allowance. Because sales returns and allowance is a contra to the revenue, its plus sign is on the left side. So how much did they return? Well, they returned 100 books. And how much are we charging them? We're charging them 19 bucks each. So 100 times 19 is $1,900. And then our AR goes down by $1,900. All right, now continuing the reversal. So again, here is our sale. So when the person returns it, we need to reverse this one too. So inventory, instead of going down with the credit, it's going to go up because our inventory is being returned to us. So inventory is going up. And how much do those books cost us? Remember, the first part of a sales transaction or a sales return is how much we're charging the customer. And then the second part, involving inventory is always at the cost to us. So here is how much the inventory cost us, $11.40. So again, we're just reversing this transaction. So inventory will be debited, and then cost of goods sold will be flipped. So cost of goods sold is being lowered. So the easiest way for most students to figure out how to do the sales return, remember sales return is when a customer is returning to us, is they just look at the sale and then they reverse it, with the exception being instead of crediting sales revenue, instead of debiting sales revenue, we would debit this sales return and allowance. All right. Now, I want to keep track of ARs in a T account. So remember how I started this? The T account, this T account for AR, we had a $38,000 debit for AR. So now on my piece of scratch paper, I want to go down here and I want to keep track of AR. So we have AR being decreased by $1,900. Sales return books of damaged books. All right. So we had the original $38,000 sale. They returned some of the books, so we have to lower their AR. So let's do a new balance. So our new balance is equal this minus this. So we have that $36,100 balance in AR. All right. And the reason we're doing this is once the buyer pays this, we need to lower AR. All right. Now it says Muddy River collected the balance from the Salem store. So we know we're going to get cash. I'm going to skip a line for now. And we know we have to reduce the AR. So let's go and reduce this AR. So to reduce this AR, since they're removing the whole AR, we have to credit it by the full $36,100. And how much did we say that they are saving? Remember, the terms up here are if they pay us within 20 days, they save 1%. So again, we already done the calculation, but let's do it again. The sales discount to calculate the sales discount, we multiply this times 0.01. So this gives us our $361 sales discount. So if you remember, sales discount is a contra revenue. It's opposite of revenue. So as we give sales discounts, it's going to increase the opposite of revenue. It's going to increase on the debit side. So here's what's going on. They owed us $36,100. They are saving this amount. So how much are they paying? Well, we've already calculated that. It's the same amount here. So I can just copy this. That didn't work. I wonder if I can copy that. Yeah, there we go. All right. So how did I calculate the cash? It's just the full amount that they owed minus this discount, the amount they saved, gives us the cash amount. And we're done. So this exercise is a really good exercise because it shows you the same transactions from both the buyer's viewpoint, and then in this section we did the seller's transactions.